Okay, so our Unit 5 is all about the legal aspects of corporate finance. So we'll look at some of the laws that are applicable in corporate finance. We'll start by discussing the general sources of corporate funds. We'll look at the basics of corporate bonds, which much of it was covered in financial management, but we'll try to remind each other. Then we'll also look at the advantages and disadvantages of corporate bonds. Then we'll discuss the different types of stocks. We'll be able to define what treasury shares are and explain what buyback mean. Then we will list and explain the different types of dividends and explain the concept of stock split. Then we'll look at the legal limitations on the dividends. That's what we are supposed to cover under Unit 5. Then we'll be able to proceed to Unit 6. So, what we need to understand as we begin looking at these issues, corporations require money for them to undertake the activities that will enable them achieve their mission and their goals. So for them to raise funds, we have got two broad categories of sources of funding. The first one is internal source of funding and the external sources of funding. So we have identified the four major sources of corporate funds. So we have got two major sources under internal sources of funding and the two major sources of funds under external sources of funding. So the first one is plowback. Plowback falls under internal sources of funding. Generally, in general terms, when we are discussing plowback, we are looking at the money that a company has raised out of its activities. For instance, profits that have not been distributed as dividends, sometimes called retained earning. You can use that money to invest in an identified investment. That is what is plowback means. Okay.
Okay.
So plowback is simply reinvesting earnings in the corporation. Okay. Then the second source of funding is debt security. Debt security falls under external source of funding. It is simply borrowing money for investment. Okay. So a common type of corporate debt security is a bond. So you can issue bonds, corporate bonds. Then those that have got money, they are able to lend you money in form of buying those bonds. Then you begin paying back. Okay. And now, most of the times, we tend to fail to differentiate a bond from a loan. But the general difference is the fact that,
yes.
Yeah. So the basic difference is the fact that when you get a loan, when you are making the annual payment or the monthly repayment, you are paying the principal and the interest together. But with a bond, you don't pay anything from the principal. You will be only paying the interest until the maturity period. At the maturity period, that is the only date when you are going to pay the interest together with the whole amount of money which was borrowed under a bond. And I'm sure that's the challenge we are having in Zambia for all the bonds that we got that were supposed to be paid in 2022 and in the years that are coming. Because those huge sums of money, once the bond matures, you are supposed to repay it in full. So that's the major difference. Okay. So the other source of funding is called equity security. Equity security, in simple terms, we are talking about investors' funds. The money that is brought by investors as capital and invest in the money. That is equity security. Okay. Then we can look at the private equity and venture capital. It is also about borrowing, but a venture capital is a group of investors who pool their money together for investment purposes, usually to invest in other companies. So if we need money as a company, we can go to such people and we are able to get to talk to them so that they are able to invest. And as they invest, they bring money to the company. Then we fund those projects that we have identified that need funding. So these are the 4 common sources of funding for a company. Okay. Unless if there's a question before we start looking at the basics of corporate funds.
No.
Okay.
There's no question.
Thank you. So under this, we will just concentrate on the bonds and the terminologies that are common when we are dealing with bonds and how we treat bonds as we account for bonds. So a bond is a long-term debt instrument issued by a corporation or government. You need money, all you can do is to create a bond, a so-called a bond certificate. Then you make an advert that we are issuing bonds. So the bond that you are issuing, you set a price, which is the original price of that bond. It has got so many names. It is called the maturity value. It is also called the face value. It is also called a par value. It is also called a nominal value. You are just talking of the same thing. So whatever the examiner picks, you are able to figure it out. We are talking about the original price of the bond certificate. Okay. So for instance, if we issue a bond, we can say our bond price, which is the face value or the nominal value or the maturity value or par value, is 1,000. Meaning this is the money that a person will bring for him to buy a bond. Now, we are going to have other terminologies. We'll look at the yield to maturity. That is the rate of return that an investor would earn if he bought the bond at its current market price. And as long as you hold it until the maturity. So the yield to maturity is the amount of money in terms of rate that an investor will get at the end of the period of a bond that he will buy. Then we have yield to call. That is the rate of return that an investor would earn if he bought a callable bond. Now, a callable bond is a bond that has a clause such that if we have enough money, we are able to call the bond back. Instead of waiting for the maturity period, for instance, of 10 years, maybe just after 6 years, you can say, actually, we have already raised enough money. Can we call back our bond? Then we are able to call, bring back the bond, then we give you back your money. That is a callable bond. Okay. Yes. So, bond coupon rate is the stated rate of interest. So the coupon rate is the rate of interest. For instance, if we are saying we are issuing a 1,000 kwacha per value bond at the interest of 10%. What does that simply mean? When people buy the bonds, they bring their 1,000 kwacha to the company. If this bond is a 10-year period bond, for the next 10 years, we only be paying them 100 kwacha per year, 100 kwacha per year. In the 10th year, we are going to pay them 100 kwacha, then pay them the 1,000. Then the transaction closes. Is that clear?
Yes.
Okay. So that is a coupon rate. A coupon payment. Yeah, a coupon payment is just a monetary value. So this 10% is a coupon rate. The 100 kwacha, which is the percentage of the bond price, is the coupon payment. Yes. Now, they are what are called the discount rates. This is the rate at which future cash flow streams from a given asset are discounted to the present value, hence deriving at the price or the value of the asset. For instance, if we are saying this bond has a maturity period of 10 years, but its value is 1,000. We want to know what is its value for the 10 years. So these 100 kwacha that will be coming for 10 years. Now, 100 kwacha that will be received 10 years from now is not 100 kwacha. So we have to discount it back to today. That is the discount rate. Okay.
No.
Yes. And most of the times, if we are to discount the values, we use the cost of capital. Usually we are given the cost of capital that the company is using. That is what is used as a discount rate. Okay.
I haven't understood there.
The discount rate.
You're saying 100 kwacha today. 100 kwacha today won't be 100 kwacha 2, 3, 10 years later.
Yes, if we are told
now where I'm getting confused,
yes,
discount rate, instead of it earning more, like it multiplies.
Okay.
For example, maybe I put it in a way whereby I
when you are discussing, what you are talking about is the compound rate.
Okay.
Yes, because a compound rate is an investment. So if you have 100 kwacha today, and you are saying this 100 kwacha 10 years from now, how much will it be? That is a compound. But what we are saying is you don't have 100 kwacha, but you are expecting to receive 100 kwacha 10 years from now. So you can't say the value should be higher because you don't have it for it to accrue the interest. Yes.
Okay.
Yeah, so we are growing it, going back using the cost of capital. So when you are compounding, we use the formula of A brackets 1 plus 1, 1 plus R closed brackets raised to T. That is compounding. But when you are discounting, that T becomes negative.
Okay.
Yes, then you arrive at the present value. But when you are compounding, you want to find the future value.
Okay.
Yes. So that's that. The maturity
All right.
The maturity period we have already talked about. This is the time that it will take for the bond to be paid in full. So it can be 5 years, 10 years, 30 years, and so on. The maturity date, we are talking about the date upon which the bond must be paid in full. Then there are core provisions. It allows the issuer of the bond to call back the bond, as we were discussing. When we issue this bond for 10 years, we put a clause. If we are able to make enough profit and be capable of paying back the bond, we are able to call it and pay you your money. Okay, then you agree. So you make a core provision. Okay. So there's also a core price, meaning that is the price at which the bond will be paid if it is called back. Okay. So these are some of the terms that are common when we are dealing with the bonds. Unless if there's a clarification or a question somewhere before we proceed.
No.
Okay. So on this slide, what is here, we are looking at the advantages and the disadvantages of a bond. One of the advantages of a bond is that it tends to be less risk and less volatile than stocks. If you agree to say it is a 10% bond, it will be a 10% bond. And you are assured that it will be bringing a 10% every year until its maturity for me to receive the money that I've lent to them. Then it is why the universe of corporate issuers and bonds to choose from. You can choose where you want to get your bonds. Okay. Then the corporate bond market is among the most liquid and active in the world, meaning there's easy cash available as compared to other means of raising money. That's why I'm sure you saw the Zambian government landed into bonds here and there, all over bonds. And then we have difficulties now to repay back. The disadvantages: lower risk translates to lower return. The principle of investment is that when the risks are higher, then the returns are higher also. So if we are saying bonds have lower risk, then the return should be very low. Then many corporate bonds must be purchased, okay, over the counter. So it's just there and then you buy it, okay. The OTC means over the counter. Then corporate bonds exposed to investors to both credit default risk as well as interest rate risks. So it is subject to default risk, just like the way the Zambian government has defaulted paying the bonds. So it's one of the risks, okay. So bonds, we are done. We look at stocks. Now, bonds, they fall under debt, okay. Then stocks, the common stock is falling under equity, okay. So a stock is an investment into a public company, okay. It's more or less like a share, okay. So we have got common stock. Now, if you are new to investing in stock and you're looking to buy a few shares, you likely want to invest in common stock, which is exactly what the name suggests, the most common type of stock. When you own common stock, what happens? You own a share in the company's profits as well as the right to vote. So most of the common stock shareholders, they tend to be the owners of the company. They receive profit. They also vote at the AGM, but they have their own disadvantages because they cannot receive dividends before other stockholders. So if the money that is available can only pay other types of stockholders, then they don't receive anything. That's why the only benefit of common stockholders is price appreciation, the one we discussed last time.
Yes.
Then a preferred stock, okay, preferred stock is frequently compared to bonds. They are more or less like creditors. That's why they are called preferred. So whenever there's money to pay, dividends to pay, you start by paying them. If you are liquidating a company, you start by paying them before you pay the common stockholders. That's why they are called preferred stockholders. Treasury shares and buyback. What is a treasury share? Also called the treasury stock or reacquired stock. We are just talking about previously outstanding stock that is bought back from stockholders by the issuing company. So if you issue the shares, okay, but before these shares could be bought, then you are able to buy them back from Lusaka Stock Exchange. You buy them back yourself. Those are treasury shares. Okay.
Okay.
Yeah. What is buyback? The difference is very slim, so we need to understand. A buyback, also known as a share repurchase, is when a company buys its own outstanding shares to reduce the number of shares available on the open market. You have issued them, they are already on the open market, okay? Now, you as the company, you also participate to buy so that you reduce the number of shares. So while other people can buy, the company also itself buys and keeps them, okay? Meaning at a certain particular time, maybe when the value increases or what, again, you can sell them. That's what a buyback is. So companies buy back shares for a number of reasons, such as to increase the value of remaining shares. Yes. So you keep them so that in future, when the market demand increases, you offload them. Okay.
Okay.
Yes. So let's look at the types of dividends. Okay. They are what are called, okay, what is a dividend? A dividend is just a share of the profit that is paid to a shareholder. So they are what are called the cash dividends, which is the most common, where you make profit, then you share that profit to the shareholders in terms of money. There's a stock dividend, where instead of paying the shareholders money, you only give them shares. Meaning if you had 100 shares, your shares will increase maybe to 25. Okay.
All right.
Dividends, where instead of paying you money, the company decides to be giving properties. For instance, if the company has got houses, it just give a house to a shareholder, which is valued to the amount of dividend which was supposed to be paid. That is a property dividend. Sometimes vehicles and the like.
Okay.
Okay. We also have the last one, okay, liquidating dividends. When the company is being liquidated or winding up, and the company's assets are distributed among shareholders by paying in the form of a dividend. We don't have money to pay you. We are only going to give you the assets that the company has as we are closing the company. So the difference between property dividends and liquidating dividend is that liquidating dividends are only paid assets to shareholders when the company is winding up. Are we together?
Yes, sir.
Okay. Stock split. Stock split, what is it? It's about increasing the number of shares. So if you had 100 shares, we decided to split them. Depending on the ratio, if we're using a ratio of 1 to 2, it simply means we are going to have 200 shares. But the mathematics that you need to understand about the stock split, when you multiply the stocks by 2, you divide the share price by 2.
Oh.
Get that? You multiply the shares by 2 and divide the share price by 2.
So
then you
maintains this.
Yes.
Maintains the same value.
You maintain the total capital.
Okay.
Yes.
Okay.
So the legal terms, the limitations on dividends is that the business is insolvent. So you can't pay. You can only pay dividends when you have made profits. So there are some restrictions that are there. There's no way a company can be paying dividends when it is not making profits. Okay. So those are just the legal limitations. So you have about 6 questions, which you can try. The 4 main sources of corporate finance or corporate funding. Then what is a par value? Then you define stock with reference to corporate finance. Then you define what a dividend is, explain what a stock split is, and discuss the sale of stock or the issuing of shares. We'll pause a bit as we load in our next unit 6, unless if there's a question now.
No.
Okay, so just a minute, we can just allow me to log in for the next session, then we start.
All right.
Okay, thank you.